Hi, my name's Andrew Masters, an analyst for FIBO Group, and in this video we'll talk about double candlestick patterns. So you already know that there are single, double and triple candlestick patterns. Double candlestick patterns differ from single candlestick patterns because they require at least two candlesticks. To make a decision, open a position. Comparing the factors of a single and double candlestick patterns, the shadow has the highest level of importance for the majority of the single candlesticks. The size and colour are important for the double candlesticks, but the shadow has a certain meaning for them as well. The shorter it is, the better. So, welcome to the world of double candlestick patterns. We will analyse only the most popular patterns because there are a lot of variations. The main thing is to understand the general principle. The first pattern we'll study is the engulfment. Let me remind you that the market should contain the strongly marked uptrend or downtrend for the analysis of candlesticks. During engulfment, the body of the second candlestick overlaps completely the body of the first one. It can happen that the shadows do not get engulfed. The second body should be of a contrasting colour. Traditionally, the engulfment is bullish and bearish. How to place a pending order in a double candlestick pattern. In the case of a bearish engulfing, we set the pending order below the low of the second downward candlestick and at a distance of about 5 points. Stop loss will correspond 5 points above the high end of the second candlestick. In the case of the bullish model, we set the pending purchasing order 10 points above the high of the growing candlestick, and the stop loss will be 5 points below. That's all. We should only wait. The next popular model is a dark cloud cover. It's formed at the top of the market when the power of the bulls is exhausted. This model compromises of two candlesticks. The first candlestick is white, a strong body. The second candlestick opens above the previous one and closes at the minimum level of the previous candlestick and overlaps its significant part. In fact, it looks like a black cloud covers a white candle. The antipode of the dark cloud cover is a cloud gap. Everything is the same. It's at the bottom of the market. The first candlestick is large and dark. The second one is white and opens below the closing of the previous candlestick. It closes not far from the opening and overlaps its significant part. It means that the market reversal is possible. It's easy with position opening and stop loss. A bear pattern is entry to the position 5 points below the low of the black candlestick, and the stop loss is 10 points above the high. Bull pattern is a pending order of 5 points from the high of the white candlestick, and the stop loss is 5 points below at the lower point. There are a lot of pattern types, such as piercing line, rails, and harami. All of them require a special approach. You can refer to the price action course for more details in private with a price. Now I'll represent the tweezers to you. They consist of two candlesticks of contrasting colour with the same max or minimum. Let me turn your attention to the fact this is not a separate combination, but the enhancer of other combinations. The same maximum or minimum indicate that the level is extremely strong. Here are some examples of tweezers. Tweezers, dark cloud cover. Tweezers, inverted hammer. Tweezers, hanging man. We should make a decision about the market entry and set the protective orders according to the type of candlestick pattern. Further on, we'll study in practice how the Japanese candlestick signals help us in trading.